For years, the story sounded settled. China would never allow its currency to rise too much. Its economy, still fragile at home, needed exports, and exports needed a weak yuan. That belief shaped markets, diplomacy, and policy debates around the world. But here's the uncomfortable truth. That story is breaking down. Quietly, almost invisibly, pressure is building beneath China's currency system. Not from speculation, not from sudden capital inflows, but from the system itself. A massive trade surplus, an undervalued real exchange rate, savings trapped inside a closed financial account, and signals, subtle but persistent, that the foreign exchange market is no longer ignoring. For the first time in years, the question is no longer whether the yuan should rise. It's whether China can still control how it rises. If you want to understand where the next global economic tension may come from, stay with me. Because to grasp what's happening now, we first need to clarify what exactly has changed and why it matters. Let's be precise about the problem. China is not facing a currency crisis in the classic sense. There is no panic, no sudden opening of the capital account, no uncontrolled surge of hot money. What China is facing is something more structural and more difficult. For years, the yuan was thought to be under depreciation pressure. Rate differentials favored the dollar. Private capital flowed out. That outflow conveniently offset a growing trade surplus. That balance no longer holds. Exports continue to surge. Imports lag far behind. And the underlying trade surplus is now widely seen as far larger than headline numbers suggest. At the same time, private outflows are no longer sufficient to absorb that surplus. As the yuan inches higher, state banks quietly resume accumulating foreign assets. Intervention returns not loudly, but persistently. This creates a dilemma with no easy exit. Hold the yuan down, and imbalances grow. Let it rise faster, and new pressures emerge. To understand why this dilemma exists at all, we have to step back into the system that produced it. For most of the past decade, China's currency story followed a familiar cycle. Weak domestic demand pushed growth outward. Exports became the engine, and a deliberately restrained exchange rate made those exports even more competitive. As long as capital was leaving the country, the system held together. Dollar strength, higher US rates, tariff threats, and China's own downturn combined to pull private money out. Those outflows acted like a pressure valve. They absorbed China's expanding trade surplus without forcing the yuan to rise. But systems change when the flows change. China's financial account remains largely closed. Savings stay trapped inside the country. And unlike fully open economies, China cannot rely on free capital movement to rebalance pressures. What happens instead is substitution. When private outflows slow, the burden shifts to the state. State banks accumulate foreign assets. Foreign exchange settlement data begins to tell a different story. The old assumption that depreciation pressure was permanent no longer fits the evidence. And once a system outgrows its assumptions, tension becomes inevitable. That tension surfaced first not as a collapse, but as a warning sign. The first real shock did not come from Beijing. It came from outside. Suddenly, institutions that had long downplayed the issue began to shift. The IMF no longer treated China's exchange rate as a side note. The idea that the yuan was significantly undervalued moved into the mainstream. What was once controversial became quietly accepted. At the same time, the scale of China's trade surplus was being re-examined. Not just the reported current account number, but the underlying reality. When analysts began to speak openly of a surplus approaching $1 trillion, something changed. This was no longer a technical imbalance. It was a systemic one. Markets noticed. So did policymakers. Warnings followed about global trade strain, about limits to absorption, about patience running thin. Even without dramatic headlines, the message was clear. This trajectory could not continue indefinitely. This was the first crisis, not an explosion, but a recognition, a realization that the old framework was no longer credible. If this trend continues, trade tensions will not stay abstract. They will become political. But the deeper pressure was still building elsewhere inside China's own currency system. To see the real pressure, you have to look past headlines and into the plumbing of the system. China's currency is not floating freely, and capital does not move in and out without constraint. That matters. When a country with a closed financial account runs a massive trade surplus, the adjustment cannot happen through private capital flows. It has to happen somewhere else. In China's case, it happens through the state. As private outflows faded, state banks stepped in. They resumed accumulating foreign assets quietly, steadily, not as an emergency measure, but as routine management. On paper, this accumulation looks modest relative to China's economy. It stays just below thresholds that trigger formal accusations of manipulation. But the scale is still enormous in absolute terms, and crucially, it no longer matches the underlying surplus. That gap is the signal. It tells us that intervention is working harder to suppress a pressure that keeps growing. It also tells us that if capital flows shift even slightly, the existing controls will be tested. This is not a policy mistake. It is a structural constraint, and constraints, once visible, rarely remain stable for long. The system can absorb pressure until it can't. The second crisis arrived quietly. Through the data, month after month, foreign exchange settlements showed the same pattern. Net purchases, roughly $30 billion at a time. Not a spike, a trend. Reports followed of state bank activity, of renewed accumulation, of signals meant to remind investors that the yuan was not a one-way bet. The messaging grew louder precisely because the pressure was growing stronger. This marked a turning point. For years, depreciation fears kept offshore dollars offshore. Chinese firms hoarded foreign currency as insurance against uncertainty. That behavior stabilized the system. Now, that logic is weakening. If appreciation is slow but predictable, those dollars no longer need to stay away. Even a gradual shift in expectations can change behavior. And when expectations change in a closed system, flows accelerate quickly. This is the paradox China faces. Move too slowly and pressure compounds. Move too quickly and capital rushes in. Managing appreciation now requires more intervention, not less. More signaling, more control, more effort to hold a line that markets increasingly question. And when markets begin to question control, the impact is never confined to spreadsheets. It reaches people. If this sounds abstract, let me bring it closer to you. Exchange rates are not just numbers on a screen. They shape jobs, prices, and choices, often without warning. When a currency is kept weak, exporters benefit. But households feel the costs through distorted prices and limited purchasing power. Savings stay trapped. Opportunities narrow. For Chinese firms, a slow, controlled appreciation changes behavior. Holding dollars offshore no longer feels safe or smart. Decisions shift. Hedging becomes guessing. For workers and consumers, the effects are quieter but real. Growth driven by exports does not always translate into stronger domestic demand. And when imbalances grow, adjustments rarely fall evenly. You may not follow foreign exchange settlement data, but you feel uncertainty when systems strain and signals conflict. This is why currency policy matters. It decides who absorbs pressure and who is protected from it. If you want clearer analysis like this, grounded in systems rather than slogans, take a moment to follow and share. Because the next stage of this story doesn't stop at China's borders. What happens to the yuan never stays inside China. A currency held below its real value doesn't just boost exports. It shifts market share quietly, persistently, and at scale. And when that shift accelerates, the global system reacts. Trading partners are already under strain. Export volumes surge from one side. Imports lag in the other direction. The imbalance becomes visible not in theory, but in factory closures, political backlash, and trade warnings. This is why patience has limits. As China continues to gain global market share, tolerance erodes. Institutions that once urged calm begin to recalibrate. Governments that avoided confrontation start to prepare responses. The risk is not a sudden collapse. It is escalation. Slow appreciation that fails to correct real undervaluation keeps the surplus expanding. And an expanding surplus invites retaliation, tariffs, investigations, pressure campaigns. At that point, exchange rate management turns into foreign policy. The yuan becomes more than a currency. It becomes a symbol of imbalance in a system already under stress. And when symbols harden, flexibility disappears. That leaves only choices, none of them easy. From here, China faces three possible paths. The first is gradual adjustment. The yuan is allowed to appreciate slowly, just enough to signal movement, but not enough to change the real exchange rate. This path buys time, but it also lets imbalances persist. Pressure doesn't disappear, it accumulates, waiting for a trigger. The second path is managed correction. Appreciation accelerates, intervention increases, controls tighten as offshore money begins to return. This approach is costly and complex, but it directly addresses undervaluation. It trades short-term discomfort for longer-term stability. The third path is drift. Old slogans are repeated. Warnings against one-way bets grow louder. But the system keeps changing underneath. Markets adjust faster than policy, and reactions come from abroad rather than at home. None of these paths is painless. Each reflects a fundamental choice about how much control China is willing to trade for balance. Systems rarely fail because of a single decision. They fail when leaders delay decisions until options narrow. The yuan is approaching that moment. What happens next will not be determined by ideology or rhetoric. It will be determined by constraints and by how long they are ignored. Which brings us to the final question. What should we take away from all of this? This is not really a story about a currency. It is a story about limits. For years, China managed to stretch its system, holding the yuan stable, absorbing pressure through outflows, and relying on exports to carry growth. That strategy worked because the world allowed it to work. Now the constraints are tightening. Trade partners are less patient. Markets are more attentive, and internal pressures no longer cancel each other out. When a system reaches this point, maintaining control becomes harder than adjusting it, not because policymakers lack tools, but because every tool creates a reaction. The yuan will not suddenly explode upward, but it also cannot remain where it is forever. The real question is not whether appreciation happens. It is whether it happens by design or by force. If you want to understand how economic systems actually change, this is the moment to watch. Not the slogans, not the headlines. The constraints. Follow this channel if you want clear systems-level analysis without noise. Share this with someone who still thinks currencies move only when governments decide, because the next chapter of this story won't just reshape China, it will reshape the global economy and who bears its costs,